Well, hello everybody, this is Ron Wheeler, and what I do here at VectorVest is I run our Ultimate Retirement Solution Coaching Group. And what my job is in that group is to help investors and traders create income using options. So everything we do in that URS group is options based. We don't trade stocks. Well, I guess you could say we trade stocks, but we don't actually own the shares. We don't sell the shares. Everything is done via an option and done via a spread more specifically. So what my goal is to take a position, let's say you're bullish on something like Apple, for instance, or in this case, we're going to use like the SPX or the S&P 500. What my goal is to create a trade that gives you a statistical edge, not because of some indicator, not because of some study, but because of the way that we put the trades together. We put the trades together in a way where if the market goes up, we can make money, sideways, we can make money, or even against you, we can still make money. So what I want to share with you today is how we can do that in a very limited way using one option and one instrument, and that's it. So ultimately, my goal is to help you have a simple way to generate consistent monthly income using options, just like we do in the URS. And I think this study, or I think this strategy is really going to be great for you. It's one of the most influential and effective strategies that I've taught here at VectorVest and really taught through my entire 30-year career as a trader. And to get you started, I do have a free action guide you can download right now. You can follow along with the presentation today, but all you got to do to get it is go to vectorvest.com/income, get sent to you right away. Okay, so 5 simple ways to take options out of options, and download that right away. Just enter in your name and email, and you can get the guide sent to you. Now, a lot of people, when they start trying to learn options, they end up getting frustrated and intimidated by all the terms and the types of trades that are possible. You look at an option chain, you got all these things. What strike? What expiration? It's not like buying a stock. There's things that you have to do with an option that take it one step further. And just when you start understanding things like the options, well, now you got to try to find a stock to trade, right? There's thousands of optionable stocks out there, and it can take a long time. But instead of having dozens of trades, just choose from one or two. And instead of having a lot of choices for strike prices and expirations, you want to know exactly which ones to choose instead of thousands of them out there. So we want to know exactly which one to look at and know it was the right choice. And all in all, you want a simple step-by-step system that tells you exactly what to do and when to do it. A system you're confident in and a system that you know works. Now, this is just my results from this year. 1 trade per week, $6,200 gain. That's 12.5%. Now, that's based on a $50,000 account. You could trade $100,000, $5,000, $500,000 with this. It doesn't really make a difference. And one of the things that I will also tell you is that over the course of the last decade, this system has returned a little over 2% on average per month. It's been a very reliable system, and it's been, again, one that we've been using here for a very, very long time. So I want to talk about the 5 ways to take the options out of options. I really want to simplify the process. And the key underlying principle is that you really need to narrow your selection. In other words, instead of having thousands of stocks and several other variables to worry about, you need to narrow that down. In some instances, we'll only have one choice. Others, we may have 2. Now, I love this image because it kind of suits my wardrobe great, because I wear a lot of jeans and black shirts. Why? Because it just makes sense to me. I'm not a very fashionable person, I will be the first to admit. So if you look in my closet, you see a lot of the same type of clothing. So sure, I may have a polo, I may have a, fleece 3/4 zip, but they're pretty much all black. They're colors that I understand go together. Okay? So, also, I'm narrowing my selection to make my process quick. Okay? And it's kind of like, I guess, another way you can talk about if you have kids, right? If I ask my kids what's for dinner, I can get 75 responses. But if I narrow their choices and say, hey, what do you guys want for dinner? Do you want chicken nuggets or do you want pancakes? It's much, much easier when it's all said and done. Now, when you do this with options and simplify things, it can make a huge difference as well. So let's look at how to do this. The first way to take the options out of options is simply narrow your stock selection. You could look at a list just like this one, and there's a lot of great stocks in there. You can hand pick out some great ones if you want. Or maybe even in VectorVest, we run a search, and a search will find a nice list of stocks. Even so, it's a list, okay? What we want to do is teach you how to be more efficient with your time. So instead of focusing on lists of stocks, I want to focus on one trade, just the SPX index. It's the S&P 500. This is the cash-based index for it. And this can be a very efficient and simple trade, as you've seen so far this year for me and over the course of history. Now, why only the SPX? Well, number one, it reduces your analysis time, right? You just open up a chart and start trading it. You don't have to run a scan. You don't have to look at 10 different stocks. It's quick. There's no earnings. There's no dividend worries where you have to worry about, I'm short this option or earnings create a big gap. Nothing like that. There's no large gaps based on random news. Now, you might differ with me on that opinion, but when I think of a large gap, I think of a stock having a 40% drop unannounced because of, let's say it's a pharmaceutical stock that has a bad clinical trial, or some kind of political wind shifting and a stock goes down 25% in one day. You're not going to get that on the SPX. Another good thing about this, and I get this basically from a lot of clients I've taught options to. Well, Ron, what happens if I'm in an option and I sold an option and, I get exercised? These options cannot be exercised early. They only exercise after expiration, and we never carry these to expiration. So you have you have zero risk of worrying about stock exercise. These are cash-based. They're settled in cash after expiration. It's what's called a European-style option. They're also heavily traded. You never have to worry about whether you'll be able to get in or out of these trades. Now, let's talk about, again, taking that option out of options. So we're going to narrow our side selection. In other words, there's two sides to every trade. You've got an option buyer and you've got an option seller. Now, what we do in the URS group and what we do all over is we concentrate on being an option seller. Now, listen, option buying has its place. In fact, we have a whole course which teaches investors how to buy options the right way. So we do believe there's a place to be an option buyer when you do it right. However, if you want to create monthly income streams, option selling is what you're going to do and what you're going to focus on. And the option seller makes money in two of the three scenarios. Okay? So a stock can do one of three things. It can go up, it can go down, and it can go sideways. Now, as an option buyer, in order to make money, that stock needs to go in the direction you want. That means you can only make money in one of the three scenarios, right? If the stock goes up, you win as a buyer. If it goes sideways, you don't. If it goes down, you don't. Now, that also means that the seller of the option would make money in two of the three scenarios. Now, also, to be fair, you could make money even if the stock goes against you as an option seller or the S&P. That's the beauty of it. Now, most option buyers out there don't do it correctly. Well, they probably didn't take our course, right? But anyway, since many option buyers don't buy options correctly, what our goal as an option seller is to take advantage of that. So an option seller benefits in three main ways from all the mistakes these option buyers make. And since most option buyers set their expirations too close, they set their strike prices too far away, you as the seller are going to take advantage of that. As the seller, you're going to start the trade by receiving the premium instead of paying it. So to generate a consistent monthly income, you're going to be an option seller. That's the second way you're going to take the options out of options. Now again, to get started in this, download that free guide, 5 simple ways to take options out of options. All you got to do, go to VectorVest.com/income, put your name and email in there, and we'll send it right away to you. All right. Now the third way to take options out of options is to simply narrow your trade type selection. When it comes to options, there's a wide variety of trades you could do. Here's a list just to give you an idea. These are all very, very good option trades. But what we're going to do is we're going to take the options out. We're going to narrow it just to 2. That's it, 2. One is called a bull put spread. One is called a bear call spread. And don't let these terms scare you. I'm going to show you examples in just a second. But think of it this way. Bull means that the trade is bullish, so you want to place it when the market is rising. Puts means you're going to use puts in the trade. And on the other side, bear, this is a trade that you're going to make when the market's bearish, and you want to place it when the market is falling. And calls mean you're going to use calls in that trade. So let's take a look. What if you are bullish? Well, you got one choice, right? That bull put credit spread. And again, don't freak out here. Bull means you're bullish. Puts mean we use puts. And credit means you receive a credit when you place the trade. In other words, money is actually coming into your account at the beginning of the trade. Spread simply means we're using two different strike prices. So let's look at an example here. This is more of a current market situation. We're obviously right now in a DEW up. Now, I trade my system using the DEW. So when the DEW is up, I would use that bull put spread. When the DEW is down, I would use the bear call spread. So when the DEW is up like it is as of we're making this video, I'm going to narrow my selection down to the SPX. That's the only thing that I'm going to trade. And this was like 2 trades ago, by the way. So on that day, we are going to do what's called a bull put spread. So what we're going to do is we are going to sell a put below the current price of the SPX. Then, as insurance, we are going to buy a put even lower. That's the bull put spread. It's the simultaneous selling of a put and the buying of a put as insurance. Now, look at this particular example. Now, again, this is a trade I took, I think last week was this trade. One of the things I want you to point out for sure is, look at the market that day. When I took this trade, the market was actually down like right down here, okay? And people always ask me, Ron, the market is down huge today. Why are you doing a bullish trade? Because overall, the market is still bullish. Just because the market's down that day doesn't mean that the market's not bullish. It just happens to have a down day. And you can even see that towards the end of the day, we rallied back up. And that's the beauty of this. Now, another thing I will tell you the beauty is here, right? Let me erase all these colors. Now, if the market goes up, I make money, right? Now, what else I'll tell you, if the market goes sideways, I'm still going to make money. And as long as the market stays above this level right here, I can still make money. So the market can even come down a little bit, and I'm still profitable in that trade. Now, in that particular example, right, the S&P rose, and I closed the trade in 3 days, and it was a quick $1,200. Now, again, that $1,200 is based on a $50,000 account. Okay, so if you were trading 100,000, it'd be 2,400. If you were trading 25,000, it'd be 600, and on and on and on. This system can scale up nicely, and it can go down as low as $5,000. Now, they don't always close in 3 days, but I will say that the average length of trade is about 3 to 5 days at the worst. Okay, now again, if you're not understanding everything I'm showing here, don't worry about it. Okay. The main thing is we can take the guesswork out of these trading options. Now, we've looked at the 3 first ways. Narrow your selection of the SPX. Focus on selling options. We sold a put and we simultaneously bought a put. That's called the bull put spread. Okay. Now, due to the current nature of the market, I'm just going to concentrate on bullish in this example. But again, when the market turns bearish, we would do the exact same concept. We would sell a call above the current market's price, go out a little bit farther, and buy a call as protection. Now, let's look at the last 2 ways we can take the options out of options. The next way is to narrow your expiration selection. Options can have many different choices when it comes to expiration dates, especially the S&P. You got options that basically expire every single day. There's a lot of options to choose from here. But we're going to narrow that down by simply understanding the concept of putting time on your side. We talk about the mistakes that option buyers make. One of the mistakes that a lot of option buyers make is they have expiration dates that are simply too close. Well, when you choose options that are too close to expiring, the premium becomes really, really inexpensive. And it's really inexpensive because, like a steak on the discount rack, it goes bad really soon. But we're not going to buy them. We're going to be the one who sells it to them. So just to kind of give you an example, this is how an option decays in relation to time. In the upper left-hand corner, you've got an option 180 days out from expiration. And you can see that it slowly loses its value, but then something kind of magical happens right about here. That's 45 days to expiration. You see that the value of the option starts to decline exponentially. A mistake that a lot of option buyers make is they choose options to buy in this window right there. Well, we're not going to do that. We're going to sell options in this window. Now remember, you're the seller. So if the price of the option declines after you sell it, that's good for you. And that's something that you got to kind of get your head around, right? When you buy something, remember the idea of you buy low and sell high? Well, as an option seller, it's a little bit different. We're going to try to sell when the prices are high, and then we're going to try to exit when the prices go lower. And that's one thing you have to understand also. When we do these trades, you are entering the trade and you are going to be exiting the trade. So I enter at a certain price, I exit at a certain price. Okay? Now what we're going to do is we are going to narrow that selection down even further. So what we're going to do is we're going to narrow that window down in the SPX to a 9 to 25 day window. And that's going to depend a little bit on current market situations, whether we go with a very short-term trade or out to a longer-term trade at 25 days. Now remember, regardless of whether the 9 to 25 day window is used or where in the 9 to 25 day window is used, it doesn't really matter. The typical trade's still going to take 3 to 5 days. But that longer window sometimes will give us a little bit more room as the market becomes volatile. Now, also again, want to highlight, if you're interested in kind of getting started in this, go to VectorVest.com/income, download that free guide, and it's just a good, simple way to talk about what we've done here, and you can download it and kind of read a little bit more into this. Now, the next thing I want to talk about in the fifth way is to take the options out of options is narrowing your strike price selection. If you don't have a way to narrow your selection, i.e., which option do I sell? Which option do I buy? Ultimately, you have a lot of choices. We want to narrow that down by avoiding strikes, okay? Now, I love bowling. I bowl twice a week typically in leagues. I bowl lots of tournaments every year, and I've got this down to a science. And for bowling, it's kind of like the opposite here. When I bowl, I don't want to hit the gutter. I want to hit the pocket, right? The 1-3 pocket. That's this area right here. That's where I want to hit. And as a bowler, you got to hit it at the right angle. You don't want to be too high or too flush. You'll leave a 7 or a 10 pin. You might leave something crazy. I can go on to that for hours. But anyway, when it comes to options, I actually want to avoid that area. This is where in the options world I could lose. So I want to try to steer my trade around that head pin. Steer it around that movement. Put it in a gutter if I have to. I want to get around that. The idea here is I want to select an option strike that's far enough away from the current market that I have a very low probability of getting hit. But I can't go too far, right? Like in here, if I throw a gutter, I don't get any score. Or let's just say the 7 pin's out there. I got to avoid the middle and hit the 7 pin. If I go too far to the left, I throw a gutter and lose. If I go too far to the right, I'll miss it altogether. Okay? So again, look at the example from earlier. Remember how we talked about when I did this trade, the market was probably somewhere down here, right? I want to create an area to where I can be right, even if this market goes sideways or even comes down a little bit. But not too far against me, because then the risk becomes a little bit more ugly, okay? So this is the concept of standard deviation and probability, right? If you've ever seen this, this is like the bell curve, if you remember from school. The bell curve says data has a tendency to kind of all collapse around the middle, right? And then as you get to the outsides, you'll see less and less data. It's kind of like, right, if you have a target. Here's a target. And I have a bullseye, right? And I tell people to take 10 shots. Now, I'm not talking about a marksman. I'm talking about just the average person. They might get 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? Most of the data will appear in this area. If I expand it out a little bit, most of the data might even be in here and here, right? But then there's going to be the data on the outset, the outliers. What we're going to have to do is we're going to have to choose data and choose strike prices, not in this big area right here. It's going to have to be a little bit outside that to make it give us a probability of winning. We're going to choose the strike prices towards the edges of where all the data typically lies. Okay? And think about this. How much easier would it be if your choices were narrowed down to simply one or two? Okay? It's a lot easier. Now, we teach our clients what we call the SPX paycheck system. It's a 5-step process, and again, it's all designed to take the options out of options. We start with market direction. Now, today we looked at bullish markets, but if the dew is down, we would place bear call trades. If the dew is up, we place bull put trades. We only use the SPX, so there's no real big selection here with stocks. Option selection. We're going to do either a bull put or a bear call. It's simple, right? If it's up, bull put. If it's down, bear call. Trade setup. We already talked about it. Strikes a little bit outside that area of all the data grouping up. Expiration, 9 to 25 days. Okay? Trade management. Oops, I accidentally skipped a slide there. Trade management. We're going to get out of the trade at a preset profit. We're going to exit the trade if the market moves too far against us to preserve capital. So we put together a great course for this if it's something that you're interested in. We call it the Income Investment Challenge. And here's how we're going to do this. So as Stephen Covey said, let's begin with the end in mind. The challenge is to have you place your first income trade on September 29th. Yeah, that fast. We want you to do this quick. That's the whole process. That's the whole reason behind it, right? It's a quick, easy trade that anybody can learn. So to do that first trade on September 29th, we are going to start training you on Tuesday, the 23rd. At 11 a.m., we're going to do a live trading class, and we're going to do them for the next 4 days, Tuesday, Wednesday, Thursday, and Friday. Now, these are all recorded, okay? So you don't have to view them live if you don't want to. You do have access to recordings. But in those 4 days, we're going to teach you the fundamentals of this trade. That way, you are ready to place that first trade with me on the 29th. And in fact, we're going to trade together for 4 weeks. So all through that series, I'm going to get with you. I'm going to show you how the trade works. I'm going to show you how I do my selection. And we're going to do the trade together. That way, you are 100% confident you can place this trade. Now, also, just so we have time to kind of take a breath and understand what happened in the trade, or I should say what's happening, we're also on Fridays at 11 a.m. going to get together and just do a simple Q&A. Okay? This is a trade that ultimately, once you get the hang of it, takes less than 5 minutes. If you have a broker that supports it, you can put orders in there to take profits and stop yourself out. It's that simple. We're going to make sure that this is a trade that you get off and running in only a week's time. So if this is something that interests you, join us, okay? Our income challenge is $295. I'm going to take you by the hand and help you place that first trade. So just go to VectorVest.com/join-challenge, and together we're going to do this. And like all the courses I do here, I believe that you're going to love this challenge and learn from it. We offer 100% money back guarantee. Now, you can go through the entire challenge. If you're not satisfied, then you can get your money back. It's completely no risk. But we only want people to join the challenge if they're serious and excited to get started. Okay? So basically, we ask you, do the course with us. That's the key. So if you are interested, again, join the challenge. It's only $295. You can either give us a call at 888-658-7638 or hit our website at VectorVest.com/join-challenge. And I look forward to working with you and teaching you this very, very simple income strategy with the SPX. Thanks again, everybody. Have a great one.
Yeah.